Right. Let's start this event by me welcoming everyone to the third and final annual Money, Macro and Finance Society Conference webinar. Now, while it's disappointing that current circumstances mean we aren't able to meet in person, I'm delighted we've been able to do so virtually. And I'd like to thank Paul Meisen and all the MMF team for their work to make this event possible. I'll start, for those of you who don't know me, by introducing myself. I'm Dave Ramsden and I'm the Deputy Governor for Markets, Banking and Resolution at the Bank of England. I'm also President of the Money, Macro and Finance Society. In fact, this event marks my 1-year anniversary in that role, since it was at the annual conference this time last year that I took on the role from the legendary Charles Goodhart. Now, when I became president of the society, I outlined a vision for its work and for the economic profession, which included demonstrating that we are of the times rather than behind them, including by engaging rigorously with the most relevant questions of the day. And I'm very pleased to be able to say that today's presentation and event does just that. Digital money is a topic which is very high on the Bank of England's agenda, as well as on the agenda of many other central banks and more generally on the global policy agenda. It's highly relevant to me as a member of the bank's monetary and financial policy committees, and also as the person with executive responsibility for our contributions on fintech and our own interbank payment system. And as I've said, it's become increasingly important globally, and I think it's going to be a big theme for debates this autumn. So this discussion is incredibly well timed, and given the world that we're dealing with as we adjust the effects of COVID, I think it's becoming even more salient. So I'm very pleased that the MMF is hosting this highly relevant event that brings together theory and practice of the sort of questions that digital money is throwing up. And I'm particularly pleased to be able to welcome our lead speaker, Professor Markus Brunnermeier. Markus is someone who doesn't really need any introduction for most of us. He's the Edward S. Sanford Professor of Economics at Princeton and Director of the Bentheim Center for Finance there. He's got a long and incredibly distinguished research career spanning all, MMF, money, macro and finance, and he has a track record of engaging with real world economic challenges ranging from the causes of the euro area crisis to the economics of blockchain. And then following Markus's presentation, we'll have a discussion from Raphael Auer. Raphael is Principal Economist at the Bank for International Settlements, and they've been a leading international voice in the debate on digital money and central bank digital currencies. And he's based in their Innovation and Digital Economy unit. In that role, he's worked on a wide range of topics related to digital currencies, very much, again, thinking about their real world relevance and salience. And so I think incredibly well qualified to engage with the issues for us today. And I'm particularly grateful to Raphael for taking up our invitation at pretty short notice to be the discussant. And before I hand over to Markus, just a couple of words of housekeeping. We'll have Markus's presentation followed by Raphael's discussion, and there will then be time for quite a lot of questions, but rather than asking them in person, we have, as on previous events this week, an online system called Slido, the instructions for which have appeared on the screen magically. So whilst Markus is speaking, obviously focus on what Markus is saying, but do think of your questions that you want to pose and pose them via the event code there using Slido, and enter your name when submitting your questions. And you can log in and do that now. And then after we've heard from Markus and Raphael, I'm very pleased to say, because I can hand over my convening duties at that point to Laura Coroneo, who will do an expert job, I'm sure, of working through the questions, prioritizing the most popular ones. I think you can vote even, apparently, and we'll ask them to Markus on all of our behalves. So without further ado, I will stop there, and I think the virtual spotlight is now going to move, I hope, to Markus, to whom a very warm welcome.
Thanks a lot, Dave, for this generous introduction. I would also like to thank David, Paula, Paul, and Laura for organizing it, and the Macro Money and Finance Society at large for having me here. It's a great honor to be able to present in front of you. I would like to talk about digitalization of money, a paper I wrote with Harold James and Jean-Pierre Landau. And also I will touch upon some work I did with Dirk Knippelt on the equivalence between public and private money. But before I go into the details, I would like to spend a few seconds of silence to Thomas Laubach, who died yesterday. Everybody knows his work. He worked a lot on inflation targeting. Our star is very much associated with him and his work with John Williams. And so he died yesterday unexpectedly very early on, and perhaps 2 seconds or a few seconds of silence for him. Thank you. So what I want to talk about is about rethinking the money in the digital age. What will change? Of course, you might argue we have digital money all the time. If you have a deposit account with your bank, it's digital money. You can make digital payments. You have a credit card, it's all digital. But what we didn't have so far is essentially having digital outside money. So outside money, provided, which is additional money, which is not the liability of the issuer. Okay, so and also, of course, there are many things occurring on top of it as well, with M-Pesa, Alipay, Libra is all over the news and so forth, and has changed over the last month significantly how Libra will be designed. So, and I would like to get an idea what's going on and what are the big changes we might be facing. In some nature, this talk is more speculative because I'm looking into the future rather than using past data and deriving a deep analysis of the past data. But some questions which emerge, and here you see a beggar in China, instead of collecting coins, he has, Alipay and a WeChat Pay QR code around his neck, and that's how you give him money. So the question is, will private digital money drive out cash? And if that's the case, will it be the case that monetary policy will lose its grip? Will it be the case that Facebook will be more important conducting monetary policy when Libra becomes more prominent or not? Okay, that's a provocative statement. And more mundane, you can still maintain perhaps monetary policy, but it might be the case that the seniorage benefits go to private banks or go to private companies or big tech companies. What's about digital dollarization? Will certain economies lose their own monetary authority, and essentially some digital currency will take over? So it's dollarization, which we normally have already for smaller countries. The dollar is essentially overrunning the local currency, but it could be some digital currency overrunning the local currency. Will we have new currency areas in form of digital currency areas? So in this paper we discuss what is a digital currency area, and what role will central bank digital currency play in this context? So these are the questions I would briefly address. I will not answer all of these questions. I will raise them and put them in context. The way I would like to talk it in this, I would like to give the following roadmap. So first, I would like to talk about technological trends and how this will affect the industrial organization of finance or money in particular. And then I will talk about new forms of currency competition. How does Hayek's idea of currency competition, is it coming back? In what way is it coming back, and why is it different now? And then I will talk briefly about the international monetary system, about digital currency areas, digital dollarization. And finally, I will talk about monetary sovereignty. I want to spend some time on monetary sovereignty, in particular the interaction between public and private money. And of course, a lot of the insights we know already. There's not so much new in terms of digital component, but I think it revives and makes us rethink and combine with new digital elements what's very, very important in the oncoming debate. So let me start with the technological trends. So I think the biggest technological trend is essentially that we have now platforms, digital platforms or ecosystems become much more prominent. So if you look in China, for example, the Alibaba platform, everything occurs, a large part of our economies occurs on digital platforms. And with the COVID crisis, this becomes even more prominent. And of course, you have a digital lifestyle, and that's what they really call it. It's a digital lifestyle. On this digital lifestyle, you have a huge data advantage. And who controls the data? So the prediction, the recommender systems in these platforms is just a tremendous benefit to have. And this benefit comes also from the payment system, because if you know what things you buy and how you pay for it, that's valuable information. And these companies are willing to pay for this valuable information. Okay, so what we have essentially, traditionally, we have a very bank-centric financial system where lending, deposit taking is important, but the banks are in the center. And we move to a payment-centric but payments was always the stepchild in the old setting. This was not really at the center. Now payments with an emphasis on data, payments become much more important, and the platforms, social networks, and that becomes much more at the center. And why is that the case? Because you can combine this data from payments with other data. And then you use some machine learning algorithm, you use some AI, and that actually gives you a competitive advantage that banks on their own cannot combine the same way. So if you Amazon Marketplace and you have all the payment information on top of it, you can combine things what people do on Amazon Marketplace or on Alibaba together with the payment data. That gives you a bigger advantage compared of being only a bank and seeing only part of the picture of that. And that's why the platforms will be at the center, and then the platforms will derive some credit scores or any other scores, and then say, okay, if you want a loan, then you go to this platform, and the platform will ask several banks to compete to provide a loan to this particular customer. So you can see the information rent is actually going to the platform, not to the bank. Which way we end up with, that depends very much on financial regulation and which model we prefer down the road. Okay, and that's something we have to think carefully about. But so the technological trends, if you think about it, are the following. I pushed very much the digital platform, the ecosystem, and that's, I mentioned, this data advantage inversion of the I/O of the financial activities. But if you step back, of course, another big invention was the smartphone. Everybody has smartphones. Smartphones are fairly cheap. Even in developing economies, everybody has a smartphone and you can make payments. You don't have to carry a laptop around. So it was infeasible before the smartphone to have this digital revolution of money. So that's why earlier revolutions like the e-money, there was a big debate also in the academic community on money, but now it's a different animal. And of course, all of this will speed things up. So you won't have 2 days of delay, and you have no more netting because everything will be settled immediately. And that means any crisis will also be much faster. So there's no way you can wait until the weekend to sort things out as a central bank and then figure out how to deal with that. It happens much, much faster. The speed is going up, and that has real implications how to manage financial crisis down the road. So another technological trend are that there will be smart contracts. There will be a lot of payments which will be automatically executed by machines or across value chains, combined potentially with blockchain technology. That's still up in the air whether blockchain will be such a big success or not, but there will be a lot of smart contracts executing payments all the time. And with the Internet of Things, these payments will often occur from machine to machine. So nobody will probably intervene. There will be a machine ordering something and it automatically paying for it. There will be millions of payments, not from agent to agent, but from machine to machine. And another invention, which is not really an invention, is a token-based way of paying things instead of an account-based. And I will come back to this later on. And this audience are probably very familiar with the distinction between the two and the distributed ledger technology. And these are, I think, I would say, these are the technological trends which really reshape the financial system and reshape in particular the aspects of money. It has a lot of huge impacts on money. So these are the technological trends I'm seeing. I think the most important one is probably the connection in the digital lifestyle with digital platforms and with smart contracts and Internet of Things and all things. There will be a lot of payments. And you can see that, when I asked my students yesterday, can you show me a coin? Everybody said, I have no cash anymore. Because even especially with the COVID crisis, everything is moving to an online world, to a virtual world. And you see the importance of cash is diminishing automatically. Now, what does it mean in terms of currency competition? Is it then the case that we still have a digital dollar, a digital pound, or a digital euro, and everything will be the same? It's just a digital form of it. Or does it mean we will have new currencies competing? Is it easy to set up a currency or not, and so forth? And here I would like to propose a new way of thinking of the Hayekian currency competition framework. So if you think about competition from an antitrust phenomenon, it's all about bundling. Now, what you do in order to avoid competition, you bundle your services and you offer a bundle. So if, for example, you're Microsoft, you want to have a browser integrated in your software system, so you bundle it together, and that reduces competition. When you think about money, money has three roles. It has three services. It serves as a unit of account, it serves as a store of value, and as a medium of exchange. And money provides all of these three services in one bundle. Okay, that of course limits competition among various currencies. Okay, because you offer this whole thing as a bundle, and in particular, there is network externalities going on for that. What we argue essentially through this new technology, there will be some unbundling of these three services. There might be some currencies which are very good stores of value, or some other assets, even some safe assets. And there might be other currencies which specialize in as a medium of exchange. So you essentially hold your money in the store of value, and just a millisecond before that, you switch to another currency, which is the ideal medium of exchange for this particular platform, or whatever good or whatever it is. So there might be huge changes going on in this dimension. And that, of course, we had currency competition and different things. When we think back of gold and silver, you use gold for large transactions, silver for smaller transactions, and you have Gresham's law. Silver had a higher value because of a higher velocity, better medium of exchange. Gold was a better store of value, and you use it only for large transactions. So you have this Gresham's law playing out, and this currency competition will actually play out in this context much more severely, in particular because you unbundle the three roles of money. The other aspect I would like to say is that the switching costs from one currency to another currency is actually, the switching costs will go down. Okay, and that with the declining switching costs, you will also have declining network externalities. Right now, there is a lot of coordination to a particular currency. If you go to London or anywhere in the UK, you have to pay with pounds. If you go and want to offer them some euros, you probably won't accept it, because we all coordinate to use on pounds in the UK. And it's a little bit like Ottmar Issing compared this with a language analogy. We coordinate on certain sounds of a certain language, and switching from one language to another language is not so easy, or from one measurement in inches versus in centimeters is not so easy. And that's its unit of account role. But with new speech translation software, where we can actually just translate anything I'm saying in another language, automatically the switching costs are going away. And that means the network externalities are going away, they're shrinking, and then you have huge unbundling. You have much more fierce competition, much fiercer what Hayek ever imagined in the 1970s. So for Hayek, it was mostly to keep inflation in check, but this declining switching costs, I can switch at any minute, makes the competition much more severe. And similarly, like in a language, I can now speak in all languages, or not now, but perhaps in 10, 15 years, I can speak in all languages, and everybody understands his favorite language. Now that's the first thought. So the competition will be much more severe. The second thought is, but there will be rebundling. Okay, so the idea is that now we have unbundled the three roles of money, but then we have some rebundling with the platform. Okay, money will be attached with a particular virtual or with a digital platform, a digital ecosystem. And I mentioned already the smart contracts and all this. And there will be many competing monies, and there will be product differentiation across monies. There will be some money specializing in this feature, some other money specializing in another feature. For example, there will be a currency saying, okay, if you trade, if you use our money, it will be we protect your privacy. Hence, you get the lower interest rate. Another currency will say, okay, you get a high interest rate, but your privacy, all the information will be given away. And you can see already what Apple's strategy is. Apple is going for this privacy route. And there you can offer your own currency, saying, okay, we protect on our platform and on our digital transactions your privacy enormously, while this was costly because we can't sell this data. Hence, you get the lower interest rate or get less compensation. You have to pay higher fees and so forth. And of course, the question is to what extent this will be closed ecosystems. That's where the concept of interoperability comes in, or it will be open to what extent you can switch from one currency to another currency. And that's also where the digital currency areas are coming in. Okay, so that's the question is, what is a digital currency area? What's a currency in the first place? So we talk a lot about in this paper, thinking about it. What is a different currency? When is it part of a currency, and when do you start with a new currency? And it's not so black and white as it seems. So in terms of the international monetary system, there's this digital currency areas and the digital dollarization. Let me just allude to this briefly. So a digital currency area is an area where the own unit of account or payment instrument is only inside, okay? And it's typically complementary with a digital platform. So if Facebook says, within our platform, you get this huge subsidy, you can pay with Libra, outside you can't, and you see already a digital currency area doesn't need to be a geographic area, okay? It can be in a digital space. It's not attached to any national borders, okay? Now, having said this, in the last section of the paper, we argue then actually the geographic area will come back because of different regional privacy regulation. Okay, so what matters a lot, what will be the areas of privacy and data regulation? So if the European Union is forming a privacy regulation, that might form also then a digital currency area, and that's where the geography comes back into play. Okay. But essentially, if you use trading within a digital currency area, typically you get price discounts. That's how Alibaba's payment was put on and so forth. And essentially that's what defines a digital currency area. The other question is, what's about digital dollarization? I alluded to this already. Who is vulnerable to our digital dollarization? And what we argued, so typically dollarization is the phenomenon that your local currency will be driven out by the dollar or by the euro or some other currency. And the question is, how will you do it? Do it through a medium of exchange, or do it with a store of value role? So you become an invoicing currency as a medium of exchange role, or you become more a reserve currency, and then people want to store their wealth in dollars rather than in the local currency. And the same can happen also that Libra takes over, or the new Chinese currency. And that's, once you have a digital platform like Alibaba in all the neighboring countries, and all the Chinese minorities use Alibaba payments, Alipay anyway, so Ant Financial's Alipay, then it's very easy to expand into the other countries as well, and have some digital dollarization or renminbization, whatever you want to call it. And suddenly you might lose the unit of account. And that I will argue later on, the key of the three roles of money is, if you lose as a country the unit of account, you lose your power of monetary policy. So that's the store of value you can lose, the medium of exchange you can lose, but the unit of account, if you lose it, you lose essentially your power to conduct monetary policy. And this process is highly non-linear. And there's earlier work on dollarization by Zhang and Velasco, now at the LSE, and they have actually worked a lot why this is so non-linear. So initially there's nothing happening, your local currency is still there, and suddenly your local currency is gone. Okay, and that's what, of course, for central banks is a major concern, and that's why they're concerned about that. The third point is a digital synthetic world currency, where you can now create some. One big problem is, of course, that the safe asset in the world is provided by the US, Germany, Japan. So few countries have this ability to really provide safe assets to the world. And whenever there's a crisis, there's flight to safety, and that makes it easier for these countries to do fiscal policy, anti-crisis fiscal policy, because they have, at the time of crisis, they have very cheap funding opportunities. Other countries don't have that. And the reason is that the supply of the safe asset, it's not about the quantity of the supply of the safe asset, it's about how it's supplied. And that depends that only certain countries can do this, while emerging economies cannot do this. And I have made a proposal here how we can make it more symmetric, the supply through some tranching phenomena, tranching instruments. And you can envision a digital synthetic currency doing this, and Mark Carney in an earlier Jackson Hole paper was outlining this in detail. Now, let me move on and spend my remaining time on monetary sovereignty, because I think that's probably for central banks the most relevant aspect. And then the question is also, to what extent should it be in private hands, and to what extent it should be in public hands? Okay, and that's a huge policy issue. Yeah. And monetary sovereignty has many flavors. And of course, it's about seigniorage. But I think, in my view, monetary sovereignty is mostly about managing the macroeconomy, stimulating the economy or cooling it off and things like that. And that's, the question is, how can you preserve this? And I alluded to this already. So what's the current arrangement? The current arrangement is essentially a two-tier arrangement. We have the government offering outside money, provides the unit of account, some settlement, there's some private-public partnership in a sense. But that's roughly what we have. And then there are the private banks who offer the inside money, the deposits. But, the outside money and the unit of account is under the control of the government. The future arrangement could look different. So instead of having private banks and governments, of course, we have a third player. So we have these big tech companies here. So that's a third player showing up. And there's a huge debate how to arrange this in the future. Should it be like the India stack model? That's what the BIS and others seem to be favoring. Should it be like what PBC, the People's Bank of China, a narrow bank model, so that essentially the government still has in control of the unit of account, and essentially there's no fractional reserve banking going on in the tech sector. That's what it seems like. The Chinese, they are very much wanting to make sure that the government stays in control, so you don't have this two-tier system, and the government is at the center of all the time. Okay, so that's these are the biggest debates here. So, and let's just talk about a little bit more about monetary sovereignty. That's what I would like to do on the next slide. Okay, let me jump this, given the interest of time. So if you think about public versus private money, and if you talk to Harold James, my co-author and friend, he says, the whole concept of public money is a fairly recent phenomenon. So we had many hundreds of years where we had primarily private money. And but then we have to think about this, which arrangement do we want to have? And you can also have some examples where there's actually no government anymore and the money is still active. So famous examples are the Iraqi dinar in northern Iraq. When Saddam Hussein went down, the money was still acting as a medium of exchange, even though there was no government anymore. Similarly, the Somali shilling is still in use and was used for many years. Even though the government went down, there was no central bank or anything like that. So there's no, in the theory, it's not clear why the government should be involved at all. Okay, but there's certain aspects, and that's what we outline in the paper, which are important here. So the first thing is the seigniorage rents. Who gets the seigniorage rents for money creation? And I will spend a lot of time on that, because that was also my work with Nippold focused on this, was also driven very much the Swiss Vollgeld initiative or sovereign money initiative was very much focused on seigniorage. Should the private banks get all the seigniorage or not? And that's also related here. Should the big tech companies or fintech companies get some seigniorage, or the banking sector, or should it be in the hands of the public? But I think for me, the more important question is who is in control of monetary policy. So is Facebook's monetary policy managing macroeconomy? If 3 billion people use Libra primarily and they have their own unit of account, but then it's an issue. And what is important is that there are some intertemporal phenomena. So the intertemporal are very, very important because monetary policy redistributes wealth by doing so. So there are two ways to view it. So if you have a New Keynesian perspective, the main friction is the stickiness of prices, and that's keeps a role for monetary policy. You can conduct monetary policy. So what matters is the invoicing. So in which currency are prices sticky? Okay, and that's Gita Gopinath focuses a lot on that, or the whole Keynesian approach is essentially just let's figure out in which currency prices are sticky. And as long as prices are sticky in your currency, then you have control of monetary policy. The other perspective comes from more from a financial frictions perspective, said, okay, in which currencies are debt contracts written? Okay, so if you have a 10-year or 5-year debt contract, is it written in pounds or is it written in dollar? Okay, and I think both aspects are important. I would lean more to the second one. I think that's very important. So because if a lot of debt contracts, the whole financial activities, if they're all done in pounds, then you're very much in control of monetary policy. But if all contracts are done in euros, you can move the interest rate in pounds around and nothing will happen significantly. And what's the role of monetary policy? To conduct a monetary policy essentially is to redistribute wealth ex post and do some risk transfer. Just a famous example essentially is, say, let's suppose you do Brexit, there's a hard or soft Brexit solution. The hard Brexit solution, there's some risk about that. And how do you share risk about a hard or soft Brexit? There's a huge risk involved. And you would like to share it with the whole population ideally. And the whole population is not trading contingent contracts on hard versus soft Brexit. So one way to share it essentially is that if there's a hard Brexit, it will be more negative and we have to share this risk. So one way to include all the other nominal claim holders in this risk sharing will let inflation go up a little bit. And if there's a soft Brexit, then we will not let inflation go up. And this way, the central bank monetary policy is sharing risk and people anticipate that and take positions accordingly. That's why communication is so important. And this way, you have a better risk sharing arrangement compared to a world where you don't take this into account. Of course, it's not the simple inflation targeting. Inflation is always the same. You take essentially into account what the outcomes will be and how you would share risk across the population. So that's one aspect. The other aspect is very much in connection with CBDC. When you introduce outside money from the government side, and then the argument is often that the private banks cannot fund essentially real projects. So outside money crowds out capital, CBDC chokes off credit. Okay, and we would like to address this. Is there any way to address this as well? And CBDC typically is seen as making the economy more bank run prone, and which we argue might not necessarily be the case, but it depends on the appropriate lender of last resort policy. Another power of the sovereignty of money is you have the power to exclude somebody from the monetary system. Okay, so the power exclusion, if the US says Iran will be excluded, that's a huge power. Or if Facebook says, you're not part of Facebook anymore, you can't pay with Libra and everybody's only accepting only Libra, that's a big thing. So you can do the whole books written on the weaponization of US dollars. And you can do this, of course, with digital currencies as well. So let me go a little bit more into this seniorage question. I will not spend so much time on the other aspects. We can go into discussion on this, but let me go into the seniorage question and become a little bit more formal how one can think about it. How much more time do I have? So I just continue on and you tell me in the middle, talk over me. I can't hear because you're muted.
About 10 minutes or so, 10 to 15 minutes.
Okay, great, 10 minutes. I will try to manage it. So the seniorage and the value of the benefits from being able to create money. And one way, that's going back to my work with Dirk, we say, okay, let's set up a very general model where, you know, it encompasses all other monetary models we know. So you have agents who maximize utility, and they are subject to a budget constraint, and they're also subject to some liquidity constraint, which has some Lagrange multiplier lambda. Okay, so that's one way to view that. And you can, you know, of course, you can say the liquidity constraint is a cash advance constraint. You can do that. You can have a money utility function and plug it in the utility function. That's another way to write a money utility function. Or you can have a shopping time model, the new monetarism models. All of this would be in this general framework we outline in this paper. There are special cases of that. Okay, it's a more abstract thing. We don't solve for the equilibrium. We just show some equivalence. That's why we can be so general and set up the problem very generally. But if we look at the Euler equation, the general asset pricing equation, so what we typically have in asset pricing, so the price, let me see whether I can go over there, the price of an asset J is given by the expected stochastic discount factor today versus tomorrow, and then you discount essentially the payoff next period and tomorrow's price. And typically we don't have this term here. Okay, but if you have this liquidity constraint here, if you solve it, you will get this additional term where there is this Lagrangian, the derivative with the asset J, and this Lagrange multiplier lambda. Okay, and let me call this whole term here, in this whole term I call capital lambda, t plus 1. Okay, that's from t to t plus 1. And then I can iterate this equation as we usually do, and then I get an asset pricing equation which says, oh, it has a fundamental value. That's the fundamental value. It has a liquidity value, comes from, because this lambda might not be 1, it might be larger than 1, because if the Lagrange multiplier constraint is binding, there is this whole term here is larger than 1. And then we have this payoff, and then there's a bubble component as well. Okay. And that's how we can price all the assets, including money. What's special about money, let's think of a cash and advance constraint. Money is actually relaxing a cash and advance constraint. It gives you additional service flow. It gives you the service flow of relaxing the cash and advance constraint. How valuable that is depends how binding this lambda is. And that's how we can rewrite all asset pricing equations, and where money has this additional lambda, capital lambda larger than 1. Okay. Now, how can I, if that's a very simple equation, so I will, for intuition purposes, we'll come back to that. Now, how can I generate revenue or seniorage? So I should say one thing, of course, to generate a bubble is much easier on an asset which has a high lambda, okay? So that's also the case. So how I can generate a seniorage by just issuing a bubbly asset, okay? So it's worth nothing fundamentals. I don't have to pay anything ever. Let's say the payoffs are, the Z's are 0 all the time. I don't have to pay anything and just issue a bubbly asset. That immediately generates some seniorage. And this bubbly asset can be issued by the government or by some private investors, okay? Or I can also do what banks do. I can say, okay, I hold certain fundamental assets with certain fundamental value. For them, the lambda, capital lambda is 1. And then I issue like low fundamental value assets, but high liquidity value assets, okay? And this way, I generate some revenue, some seniorage. Okay, so that's typically how banks, private banks, can generate seniorage. So what they do is they buy some assets where the capital lambda is 1. So the payoff has to drive the value of the assets. And then they issue some assets where the capital lambda is larger than 1, where the major thing is the liquidity service, a relaxation of the Lagrange constraint, cash advance constraint is the true value. And the difference between the two is essentially the seniorage private banks can generate. Okay, of course, often it is the case that, you know, private deposits in the electronic form are way more useful than to make mediums of transaction, because it's all electronic than cash from the central bank. So it might even better in relaxing the cash advance constraint than cash from the central bank. And that's how private banks can generate some seniorage, how they get seniorage. Of course, they can also issue bubbles in the first place. That's, you don't have even any assets on the asset side of the balance sheet. Now, in this case, so essentially there's a free lunch for the banks, so you can scale it up. But of course, what prevents the free lunch is the competition among the banks. Okay, of course, if you can do this, banks will do this more and more, and this competition will drive down the rents. So the question is always, how competitive is the banking sector? If the banking sector is less competitive, then it will be the case that they're creating more seigniorage in this sense than they have compared if they're more competitive. So if they're more competitive, they have less seigniorage, they pass essentially the rents on to the borrowers by also offering a more generous lending rate to the borrowers, and this way their margins are shrinking. So it's all about the competition among the banks, which then says, so who is actually benefiting from that? And is there some crowding out? Also depends on this competition. So that's the way I would like to think. So who is getting the seigniorage? There's, of course, for cash, it goes to the central bank. They issue essentially some bubbly money. There's no fundamental value to associate with cash. You can just generate seigniorage directly. But for all the electronic stuff, if there's no CBDC, it goes to the private sector. To what extent it's benefiting the banks or the borrowers from the banks depends how competitive the banking system is. Okay. Now, what we do, so there's a more general perspective in the paper, but let me just illustrate this with a simple example. So now the question is, if the central bank decides or the society decides, it might be a bigger question than just being decided by the central bank. It might be decided by the politicians, whether to introduce CBDC or not. So we start with an economy here where, there's a government and central bank balance sheet consolidated. That's why, there's government bonds on the liability side and on the asset side, because, the central bank is holding some of the government bonds. But the society or the government as sector as a whole issues some money, some outside money, which are held by the households. And of course, the government has some present value of primary surpluses on the asset side implicitly, and there's some implicit government equity the society is holding or the households are holding, because the government is implicitly having these claims on future tax revenue, which essentially is also from the households. And the households then, they hold some deposits to the banks. The banks lend to the firms, so the firms get some loans from the banks, and they hold some physical capital. But ultimately, everything is owned. So the firm's equity is owned by the households. You can see it here. And also the bank's equity is also owned by the households. So the households essentially own everything. And there's also the present value of the primary surpluses. That's the liability of all the future taxes the households have to pay. That's for the government sector, the equivalent. So that's our little economy. And we're putting all the pieces together, making sure that we don't forget an important piece. Now, the question now is, let's suppose the government introduces more outside money in form of CBDC. So that's what this box is, but if this box expands, and then the households have to hold it, they hold fewer deposits because CBDC is competing with deposits. And let's suppose CBDC is a perfect substitute to deposits. Okay, so rather than having deposits, people are holding CBDC. So how will the economy look like? The economy will look like this. So what will change is money will expand. So the households hold more money, deposits will shrink. And then there's some missing deposits funding for the private banks. Okay. Now what this paper does is that what do we need to do in general terms for them keep the two economies equivalent before introduction of CBDC and after introduction of CBDC? What do we need to do to keep the two economies equivalent is that the central bank essentially, this extra funding it gets from the money issuance, it passes it on to the private banks. Okay, and if it passes on to the private banks to the same rate the bankers pay on the remaining depositors, and the supply curve is adjusted this way, and the competition among you, so that's all what you have to specify in the paper, you can generate some equivalent outcome. Okay, so in general, you could, by introducing CBDC in a neutral way, in an equivalent way, so introduce some public money in form of CBDC, you crowd out some private deposits, but you replace it essentially with central bank funding to the private banks. Okay, so you can actually that's an equivalence result. It's a little bit similar to a Modigliani-Miller equivalence result. So you don't have to solve for the equilibria. You just solve that all budget sets will stay the same and all prices will stay the same in equilibrium. And hence you have the same outcome. And of course, I just give you a very particular example, a very simple example where money is CBDC is a perfect substitute to deposits. There are more generalizations where you can go through that as well. So another generalization is that let's suppose the private banking sector is so competitive, so it's a very competitive private banking sector. If that's the case, in that case, if the private banking sector is so competitive that there are no rents to be gained, so there's no seigniorage, and then the introduction of CBDC doesn't make any difference in the first place. Okay. Similarly, if the ownership of the private banks is the same as the tax burden for the government to the households is the same, so the ownership structure of the private banks and the tax burden distribution of the government to the households is the same, then you can also introduce CBDC in a equivalent fashion very easily. Okay, but these are very specific cases, and then you have to judge, what case are we in. Typically, you won't get perfect equivalence, but these are nice benchmark cases to look at. So, in general, I would like to say that introducing CBDC you can do in a neutral way without affecting choking off private credit creation. Okay, but it also means it has implications. The central bank has to fund private banks to some extent. To pass the extra funds it raises from CBDC onto the private banking sector. If you want to maintain the equivalence, if you argue you don't want to maintain it, if you just want to fund then more the government, then it's a different outcome, then the outcome will change. And you can make similar arguments what settings you need in order to make sure that the introduction of CBDCs don't increases the bank run probability. Okay, that depends very much what you do in case of a potential bank run. Now let me conclude. So I covered a lot of ground. To sum up, I think if you look at the technological trends, the importance of digital platforms, the ability to exploit data on digital platforms with AI and machine learning technology makes the whole digital world way more informative and way more powerful. And that makes also digital money more attractive. That allows platform providers to offer money at a better conditions than other institutions can, because they get this additional data information and they can combine it with other data like the central bank can't. Okay. Of course, there's other elements like smartphones and tokens and all this, but I think that they're also important. But I think for me, the connection with digital platforms is key. And the other thing is, if you look at currency competition, there's this unbundling of the roles of money that enhances currency competition because you have certain currencies specializing in particular roles and you can see a better competition. But the bundling with digital platforms, that means that you have actually less competition because Facebook, who wants to compete with the Facebook currency, who is a fantastic, of course it can be Amazon or something, but I can't offer my currency, and I've said I have this fantastic currency to offer. I don't have this platform. So what's key on this is the interoperability and convertibility. So I didn't talk about convertibility too much today, but the singleness or uniformness of money to make it money the same within a certain currency area. And we will see the inversion of IO, financial activities, access to data, banks versus big tech. So this will depend very much how the regulation will play out. There will of course be huge lobbying pressure by the banks to stay with a bank-centric lending deposit-taking framework, keep this at the center rather than the data platform. And it's not clear from a social perspective which one we want to go to. Okay. And then we talked about digital dollarization, digital currency areas, and at the end about monetary sovereignty to manage the macroeconomy and also to generate a seigniorage. So with this, I hope I didn't run too much over time. I'll pass it on to Raphael.
Markus, thank you so much. Exactly to time, covering a huge amount of ground. very clearly, which I'm sure is going to prompt a lot of reactions and questions later. But I'm going to hand straight over to Raphael now to lead the discussion with his comments. Over to you, Raphael.
Thank you very much for having me here today. Let me share my slides. It's a great honor to discuss Markus's two papers, the digitalization of money and the equivalence of public and private money. I'm going to be discussing this like with, coming from a central bank background, but keep in mind still the views I'm going to be expressing are those of mine and not those of the BIS. And obviously, right, when we think about the digitization of money, when we think about recent stablecoin proposals, the notion that in a time where retail commerce is more and more globalizing, a global unit of account would be very useful, is an exciting notion, but we should keep in mind that sort of actually they have been envisioned ever since the breakdown of Bretton Woods. For example, there is an interesting paper that's also a Princeton University working paper by Asham and Park, and it's called Artificial Currency Units in 1976. Now, of course, while sort of the notion and the vision has been there for a long time, the important point, and that is the starting paper of Markus's first paper, the starting notion of Markus's first paper, is sort of that has been technological progress that puts these notions back into the limelight, because smartphones put a payment processor in our hands, and the internet knows no boundaries. So now everybody has a payment technology, and every payment device can communicate with every other one worldwide. We have the rise of the platform technology and the venture of big techs into payments. And also, we should not be forgetting that the recent years have seen a hype around cryptocurrencies such as Bitcoin, and later another media frenzy about stablecoins, new coins, new technologies that are based on distributed ledger technology, and that at least suggest manifold new opportunities. So payments, especially cross-border payments, but maybe also domestically, could be transformed, could be radically reshaped. And I think this paper is an excellent synthesis of sort of what the developments could be and how they could affect the nature of money, of the unit of account, and of payments at large. And basically, the authors ask three set of questions. They first ask, how if new private outside money comes about, will it replace cash? Will it replace other forms of central bank money? And who will get to receive seniorage benefits in the future? Will CBDCs be the answer to the questions raised being one? And three, once we think beyond borders, is digital dollarization a threat? And will digital currency areas arise? And they built their analysis focusing on money's three roles as medium of exchange, store of value, and unit of account. So what I want to do is take a bit more a functional approach where we could focus on the properties that allow money and payments to fulfill these three roles. And what do we need for money to be useful? Well, first, money is a social convention, and this convention needs to be maintained. I need to be sure that money's value is stable and that it is a widely known unit of account, so it is a yardstick of economic activity. Once I've achieved this, I've nested the social convention of money in people's mind. I need to allow for a payment technology that allows for efficient commerce domestically. And third, if we live in a world where we have not only one money, but multiples, these monies need to be interconnected across borders. So this is a social convention and technical layers engineered on top of it that make for working currencies. And to dig into the question on whether private digital money will drive out cash, we should zoom into these three dimensions. And I think already at step one, at the social convention of money, I would disagree with the authors, although I will agree later on with almost everything. So Markus mentioned this, right? Throughout histories, there have been a lot of private currencies, and they actually worked for quite some time. And a question that we should ask is, why did they fail eventually? And I'm going to show you here a graph from my colleagues, John Frost, Hyun Shin, and Peter Wirtz from the DNB, an early stablecoin, the Bank of Amsterdam, the governance of money. And they build a very nice narrative about how the Bank of Amsterdam was able to establish its money, the florin, for a very long time in commerce, because initially, and if you look at the 1776 bars in the left-hand panel, initially they backed almost all of their currency up fully with metal stocks. That was the convertible unit it was supposed to be backed to. Once over time, the florin established itself as an accepted unit of account, it became outside money, right? And that gave the Bank of Amsterdam the opportunity to leverage and to issue debt that they thought would be profit yielding. And they also issued it out of political reason to the Dutch East Indies Company. Now, sure enough, the Dutch East India Company ran into trouble, and eventually the blue bars weren't worth that much, and the currency collapsed. Now, we could say, well, those are ancient times, but let me also point you to a more recent example, Tether, the cryptocurrency, the first stablecoin. It's a bit of an obscure construct, and we know not very much about it. But what we do know is that in the cryptocurrency ecosphere, it is used as a settlement means between crypto exchanges that do not have access to fiat bank accounts. Tether is what traders use to sell Bitcoin on exchange A, transfer Tether to exchange B, and buy another currency with these tethers. So it's the unit of account in the crypto ecosphere that cannot connect to the official system. And it has been quite successful there. But now, once it has been establishing itself as a payment means, something happened, which is that suddenly in the first half of 2019, the company didn't even claim to back all its holding up by sovereign currencies. It gave a loan to a closely affiliated company. Now, we will see how this will play out, but the key point is here, right? An essential condition for the existence of money is high quality asset backing, and technology can't solve that. It requires governance, and technology is no substitute for trust. So that is why the starting premise, if I go back to these three questions that the authors pose, I think it is unlikely that private sector initiatives will provide the foundation of the monetary system, irrespective of technological progress, because it's not about technology, it's about incentives and governance. And private, by definition, means accountable to a few investors, whereas public is a constructed institution that aims to be accountable to society at large. That is why we have seen the emergence of today's independent but accountable central banks. So having said that, my starting point is very different. Now, if we go to the other questions, will CBDC be the answer? Is digital dollarization a threat? And will digital currency areas arise? I agree almost 100% with what Markus wrote, and also what he covers in his second paper, right, where he talks about actual CBDC design. So I think CBDC can still be the answer, not because they compete with private monies, but because they allow central banks to offer a basis for innovation and novel public-private partnerships for the digital area. They allow the platform economy to integrate money. And this is also what the BIS explains in great detail in his latest annual economic report in chapter 3. So let's take a look in how that could actually happen. And I want to note that obviously no major central bank has decided on issuance of a CBDC, but an increasing number of central banks is investigating the topic. One excellent example is the Bank of England's report from this spring. And what we just did, just a week ago, we published a stock take of all CBDC approaches that are out there. We look at what are the socioeconomic covariates that make central banks look into CBDC development. We look at the approaches that are pursued and the specific technologies that are being considered. And just to give you some high-level findings, in none of the 32 countries that we survey, where we find actually efforts going on, the plan is to replace it. All CBDC projects aim to complement cash, to offer the digital equivalent to it that can, for example, be used in online contexts where cash has no functionality. We also look at sort of the operational arrangement, and we find very much exactly what I said. Central banks think about how can they provide a direct value underpinning, but still leave the private sector a large role in payments and maybe also in the operation of smart money and all the technology that goes on top of it. They are pursuing so-called hybrid or intermediate designs, where the CBDC is a direct claim, but the central bank does not operate retail payment. And central banks are also looking in the economic design. I think here, Markus and Dirk focus a lot on how central banks can sort of react to crisis if the CBDC has distorted the financial system. I think at the current stage, a lot of focus is, however, on designing economic aspects of the CBDC such that the systemic implications are limited in the first place. For example, by capping CBDC holdings, or by waterfall systems where people need to connect their CBDC holdings to an account, and if their holdings go above certain threshold, the money gets automatically transferred back into the commercial banking system. Let me go to the third point. Is digital dollarization a threat, and will digital currency units or areas arise? And I think it is. Better communication and information technology hastens the threat of dollarization. The picture here on the right is a car sales company in Venezuela, and on the windscreen it says, "I'm accepting Cele," which is a domestic US payment app. So what is happening here is that there are Venezuelans who obviously have problems using local currency, and they have relatives or close friends in the US who open accounts and let them operate and give them to the password to their relatives, who then pay domestically. So it's a US dollar-based payment system that gets used abroad. But of course, technology is only one aspect, and I think the political dimension is paramount. A national currency is a key aspect of sovereignty, and policy can, and I believe will, react to technology. So for example, what are governments doing? The cross-border payments is a key focus, right? It is one of the G20, of the Saudi Arabia G20 presidency focus topics. And the G20 has initiated the CPM, or has asked the CPMI to open the cross-border task force, chaired by John Cunliffe. And these governments are cooperating to improve cross-border payments in a cooperative sense. They see ample room for improvements within the account-based systems. And when they think about global CBDCs, they don't think about hegemonic currencies, but they think about means of connecting CBDCs across borders at the retail level or at the wholesale level. There are multiple options. And this is called multi-CBDC arrangement. So again, right, I want to conclude. I think all these aspects that Markus touched upon are key. We should think about how we came to the system that we have, and it's about governance, it's about incentives of the institutions, and now we should incorporate novel technology into the existing system. With that, I want to conclude my discussion, and I'll stop sharing my slides. Thank you very much.
Thank you very much indeed, Raphael, for for those comments and that discussion, and very much bringing this right up to date, as you were saying, in terms of the current central bank agendas and the BIS's role and your role in those. So really appreciate that. And now we've got, thanks to the very good timekeeping, we've got 25 minutes or so for questions. And I'm going to hand over to Laura, who is going to very expertly, I know, manage us through the questions. So Laura, over to you.
Yeah, thank you for the very interesting talk. So we have already a few questions. So if I can remind you of where to put your questions, you can go over to slido.com, and the code is 51009, and you can type in your question, and I will try to collect the questions and ask Markus and Rafael your questions. So I don't know if Markus wants first to reply a bit to Rafael, and then I will start asking some other questions, because I think he already pointed out some things. So maybe you want to answer first that. Thanks.
So thanks a lot, Rafael. So it's I had a very nice discussion. I really enjoyed it. I learned a lot, and also putting in more rich institutional detail compared to what I did. So I totally agree with you that governance is a key, especially for private currency, how to ensure the governance. So that's why I think for advanced economies it might be less of a threat, but it might, for emerging and developing economies, it might be a bigger threat. So if the country doesn't have a good governance structure in its place, then digital companies might be offering an alternative, like what you pointed out with Venezuela and so forth. And in this sense, you might say that's actually good. If you think for an Hayekian perspective of currency competition, it might be a good thing, because it keeps bad governments with bad governance under their tools. Of course, you mentioned technology is not a substitute for trust. I would agree with that too. But of course, there's new technologies which might help to enforce trust, some crypto technologies and other things. But we're still far away from that. I agree with that. I very much like the Venezuelan example. I think that's very nice. So I have to study a little bit more about this multiple CBDCs, how this will interact. So I haven't. I have to learn about this. I'm curious to learn more about that. And if you have any good sources to read, please let me know. So overall, I very much enjoyed it. I agree that CBDC is not a substitute for cash, but it is, of course, the case. Our whole world is shifting away from the physical world, more to an online world. And if we don't do anything, then the importance of cash is diminishing very rapidly. And we have to provide some, not a substitute, but some alternative for the digital world, which comes also from the central bank universe. Again, thanks a lot. And let's move on to the other questions which might be there. So I don't see this slide, or no, is this correct?
Yeah, so we have, I think my connection is a bit unstable. So we have a few questions. So there are a couple of questions which are about, well, the fact that at the end, like for example, states, a government can decide that taxes have to be paid in their own currency. And for example, we see this in dollarized economies. So most likely we will see this in the digitalized economy. So so the idea is how, so this is going to prevent to have fully digitalized economies. And would this be advisable or not?
Yeah, so it's true that you will not drive out the local currency totally, as long as you say you have to pay your taxes in the local currency. But it's not really the role of money to pay only taxes. So it doesn't take on then some medium of exchange role, where I can pass on the money to all the different people I buy something from and overcome the double coincidence of wants problems. This, having the ability to charge taxes in your own currency gives you a head start, gives your local national currency a head start, and combine what Rafael said in terms of governance having a better governance structure, if you're a well-run country, then it gives you a huge head start, and then we might coordinate on this particular, but the switching costs are going down. So the coordination benefits to hold on to these benefits are actually going down as well. So that's, I would say, but overall, I agree, taxes are playing an important role, and it gives the national currency a big head start.
Okay, so we have another question, which is about, for example, what does the experience that we have with Bitcoin and other cryptocurrencies? So we've seen a bit in the presentation of Rafael. So what does this imply for whether like digital currencies might supplant like currency issued by central banks?
So I think so. It depends what you view as digital, as cryptocurrencies. If you think of them as distributed ledger technologies, a la Bitcoin, I think they don't have the scale and the speed in order to really cover the transaction volume we need for a currency ledger to be active. So this way, I don't see the technology out there yet that the distributed ledger technology can take over any form of currency. And it will be most likely a centralized ledger at this stage. So I talked to some computer scientists here at Princeton. They're telling me it could be in 5 or 10 years, we have some new technology. At this stage, we don't have this technology that we can handle the scale of the transactions we need. But it could be what I often say, Napster, if you remember, a Napster in the music industry, it was really disrupting the music industry. At the end, it was not prevailing, but it was a catalyst for big change. So it could be that, these cryptocurrencies are just a catalyst for a bigger change coming up. And then, if you were to say, coming back to your initial question, is it Alipay or is it Bitcoin making a bigger difference? I would say it's probably Alipay, but it's not a distributed ledger technology. And perhaps Rafael can weigh in on this aspect as well.
Yeah, I couldn't agree more. Right? It's there are massive companies with very big customer bases, and they obviously, right, if they're going to have a real effect. Attention has been focusing on cryptocurrencies. If I've looked in my research in the underlying economics, then you actually find out that this is quite limited. There are aspects of scale, but there are also other reasons, right? Like the cost of a single transaction in Bitcoin is the equivalent of, uses the equivalent of several hundred kilowatt hours of electricity, and the overall efficiency of this system is very low. So I think, just like Markus, it's really about the attention that this topic has received, right? And I think it's a game changer in that sense, but more because of sort of dialogues within society that has started than as a technology directly. That said, just on the broader envelope of DLT, we also do stock take whether current approaches are using conventional or DLTs, and we do find that there is a slight tendency toward DLT at the prototype stage. Again, that is just it's an early stage, right? Nothing has been decided, but the proof of concepts and the pilot that are out there tend to be based on DLT, which is, it's a permissioned version that could look very different from Bitcoin, but it will be DLT, and it wouldn't involve a conventional database.
Okay, so we have a question about monetary policy. So you've been talking about how like the introduction of CBDC could affect the ability of central banks to perform monetary policy. So here there is a question that says, could adjustment of the central bank funding to private banks as a fraction of CBDC be used as an instrument of policy to influence bank lending to the private sector, we'll say?
So yes, so essentially one big role, of course, of central banks is to be the lender of last resort. And as long as there is a trustworthy entity like the central bank acting as a lender of last resort, that means that many banks will prefer to use, let's say, the pound rather than Libra as their currency, because if something goes wrong, I have some backing, I have some reliable institution, the Bank of England, to help me out. If I use primarily, hypothetically now, I give some Libra deposits out, then there might be some issue that, Facebook might not decide, okay, I give you now extra Libra in order to overcome your temporary run phenomenon. And in this way, I think that's now coming more from the financial stability considerations here. And this way, it has, again, the pound the upper hand, and makes it harder for Facebook to conduct this. And once you have this angle, that also means that the whole economy will be more tilted towards the pound, and that also means that the monetary policy contracts will be written. So because the bank is writing more the contracts, gives more deposits in pounds rather than Libras, that what I meant, the debt is then denominated, or deposits is one form of debt, is denominated in pounds. That gives then the central bank more power to conduct monetary policy. If it were the other way around, if the banks were to tend now to a large fraction to issue some deposits in different currencies, like in Libras, then the Bank of England would lose its monetary policy power, sovereignty. And but the ability or the trustworthiness that the Bank of England will actually step in as a lender of last resort with the right instruments and with the right methods, and the private companies might not, gives the Bank of England the upper hand in this as well.
Yeah, thanks. There is a question about the Friedman rule. So the question is about whether the Friedman rule would survive in a world where we have CBDC and with where we have limited informational frictions. So which would be your view?
Yeah, so essentially once we pay interest on reserves, we can always implement the Friedman rule more easily. In the olden world where we didn't pay interest and cash is not paying any interest, but then you had to have essentially drive down everything in order to get an implicit interest in order to have no distortions. Once you pay interest on reserves and you can pay interest on CBDC, it's much more easier to follow the Friedman rule. So all of the Friedman rule insights will carry on, but you can lift everything up. You have a high inflation, you have high interest rate paid, and everything, the Friedman rule is still active. Okay, so that's with CBDC and with interest paid on CBDC, you can implement the Friedman rule much more easily. You don't have to you're not restricted to a particular deflationary environment. And that's another advantage you have. Of course, some observers see this as a big advantage because it gives central banks more power to generate, particular ways of inflation and also pay interest on reserves. And in particular, people might be worried that the interest rate paid is negative, is very, very negative. And the CBDC having a very low negative interest rate, they're worried, savers might be worried that you get rid of the zero lower bound, which is a constraining factor, and in partial equilibrium, at least an advantage for the savers. They're worried about this, at least in the media you hear about this aspect a lot.
Okay, so we have another couple of questions. So if you want to ask other questions, again, you can go on Slido and the code is 51009. So we have one question about essentially the idea that money is memory, so that money can generate full information, reveal the equilibrium. And so there is no reason essentially to think that a platform like central currency would not attain this type of equilibrium. So in this sense, it would be neutral, right? So this was just a question.
Yes, so if it's all about information, it's about, money is a memory that, if I go back in history, and I teach this in my undergraduate class, if you have societal memory going on, for before we had any ledger or anything, it was just in the brains of our brains, essentially, where we had kept track who was doing something good for society, for our tribe, and who was not, and you got credit for this, and it was just in the collective memory in all of the tribe members stored. And in a sense, distributed ledger technology is a little bit similar to this. Of course, the problem with this societal memory is that you can only have it in a small scale, in a small tribe, 30, 40 people, where you can keep track of all of that. And we still do this, among family members and friends. You don't pay all the time. You just keep track of this memory. So we don't need money. And then the big innovation was essentially of coins and all that. But by going into crypto and distributed ledger technology, we essentially go back to the old thing where everything is, there's a memory stored among many, many servers now rather than people, but at a global scale. So in a sense, we have the societal memory, which started out thousands of years ago, and then we moved in a different direction. And now we have computer technology. We can actually, from an abstract level, we can go back to this where we have a distributed knowledge distributed across the globe now in various servers, making sure that the people who do something for society this will be recorded somewhere. Whether it's fair or not, it's a different question. Whether the prices are right, but at least there's a system where you can keep track of this. So I very much agree. Money is memory. It's all about information aspects to it. And it's interesting how we essentially go back in history, but just at a much different scale. Rather than 30, 40 people, it's about 8 billion people.
Yeah, and there is another related question again about what is money. So it's a question about how do you see the argument that money is the creature of law? So what would this imply for how we can the development of these digital currencies, essentially?
I think this goes a little bit back what Raphael said, if you have, and also to an earlier question, so money, you have to coordinate on something. And once you coordinate on something, what helps you to coordinate is, for example, the law and, democracy, and that helps you to coordinate. So it's, whether we coordinate the blue money or red money, very much is a question of coordination, and coordination can be helped by law and by the governance structure, which is behind. So the whole institutional arrangement countries have, that helps, and the law is a big component of that. That helps, of course, to give some foundation and some trust to the money arrangement and coordinate in this particular equilibrium that we focus on this particular currency. But just the danger of repeating myself, the switching costs are much lower. So this forces which said we have to coordinate on one and then get stuck on it. And even if the governance structure goes worse, we still keep this bad currency because it's very hard to coordinate on a new one. Because everybody has switching costs, and because of high switching costs, we stay in this equilibrium, which was good, but it turned out bad because the government got worse and worse and worse. So switching out to a new currency will be easier. So the forces to get stuck in the old currency, even though it got worse, there's hyperinflation or there's something going on, is actually, they are much weaker with digital currency. And that, you might argue, might be a good thing because it keeps essentially as a disciplining device for governments and for central banks to do the right thing.
Yeah. So we don't have other questions on Slido. I have one question, so if I can ask that. So you've been talking about the fact that digital currency imply kind of unbundling of the role of money, but somehow the bundling within the digital platform. And you said that then is going to be crucial, the role of regulation. So essentially, I think that in the Eurozone, there's been lots of thought about optimal currency area when there was a discussion of whether the Eurozone should adopt the euro or not. I wonder if there is a discussion about optimal digital currency area or in some sense, and what would this look like, or which would be, according to you, the criteria of designing an optimal digital currency area in order to somehow drive the regulation that somehow we are going to need, and hopefully it will not be too late until we have the regulation for this.
Yes, so in a sense, let me say two things. So the insights from the optimal currency area more generally are still holding, they're going to go away. So if there are asymmetric shocks or not asymmetric shocks, and then the question is, can we share these asymmetric shocks with existing financial contracts? If we have an extremely well-functioning financial system and we can share a lot of these risks with financial contracts, we can have a larger currency area. And it's often, often argued that the euro area might not be an optimal currency area, which, one can doubt or not. But if I go into countries like India, if I look at the countryside and the cities, the consumption basket is tremendously different, and nobody's arguing that it's not an optimal currency area. So I think actually we can stretch the optimal currency area much broader than we initially thought. In particular, if you have a functioning financial system where you can hedge, then this you don't need to do monetary policy in different currencies to do this. You can do it with financial instruments, so you can expand the currency area this way. Now, but what's different about digital? In digital, of course, it means it's even easier to write contingent contracts. You can even make smart contracts. That means it expands the optimal currency area even further. So the whole asymmetric shocks dimension is less of an issue. So in particular, if you have a system of smart contracts in place, and it could be that it's somehow the smart contracts are overseen or at least analyzed by central banks to say, oh, we have an optimal currency area. And because we have these contracts in place and there's risk sharing going on for these particular things, we don't have to do different monetary policy to do the risk sharing. That's the advantage if you view monetary policy not only through price stickiness, but also through some risk sharing perspective. The second thing I would like to say is in order to have this common digital currency area, in general, it's important to have a common digital area. Okay, so what will describe the boundaries of a digital currency area will be the common digital area. So if you have different privacy policy, like in the European Union, and let's say in China, there's very different privacy perspectives, then they would have different firms active, and then it's very hard to have a digital currency union across that because payments will be more difficult, and then it also lends itself automatically to different digital currency areas because they have different privacy regulation. It might be hard to do the same payments, and whether somebody can observe this payment or not, whether you can sell these payments, and so forth. And that's leads, as I mentioned earlier, this suddenly first you might say, oh, there's no national boundaries anymore. The boundaries don't matter. The geographical boundaries don't matter. But suddenly the geographical boundaries come back into play once you recognize that all the privacy regulation, digital regulation, is based on geographical boundaries.
Mm-hmm. Yeah, great, thanks.
Thank you, Laura, for taking us through that very full and rich question and answer session. So we're coming up to past the end of our time. So it just remains for me to thank Markus and Raphael once more for two very interesting, thought-provoking and salient presentations. I like the fact right at the end there that we came back to the macro in MMF and really brought up to date some considerations around optimal currency and digital areas. But more generally, there's been a huge amount over the last 90 minutes, I think, for all of us, whatever our background, to be thinking about. Certainly a lot for me as a policymaker to think through, and as I say, very, very thought-provoking. So huge thanks to Paul and the MMF team for making today's event and the rest of this week's seminars possible, and also so accessible and relevant. This is the last in the series of our MMF annual conference webinars. The next big MMF event is our policy conference, which is on we'd be going back in time, October the 19th to the 23rd. And that will feature presentations for a number of international and domestic policymakers. I've just been discussing this morning what I might say on the 23rd of October in terms of chairing the panel then. So that's a really, really interesting lineup, starting on the 19th with a session with Valerie, David and Janet, which Claire Lombardelli, Chief Economic Advisor at the Treasury, will be chairing. So hope to see many of you who are on this call as possible, and many others. It will be again virtual, I'm assuming. I'll finish now, and I think Paul may just want to come in with some very final remarks. If he doesn't, then thank you again to our presenters, and a huge thanks from me for everyone's participation and engagement. Thank you.
Thank you very much.
Let me just say one or two things just at the very end. Thanks you very much to all the participants today. Let me echo what Dave's just said, and thank Dave also for sharing it for us. I think I can say that the 3 sessions that we've had this week have been extremely successful, full of insights into really current economic issues in the area of money, macro and finance. So it's been a terrific experience, even though we can't be together and have the usual chat and discussion that we might have afterwards. Nevertheless, we've learned a lot online. It's a good substitute, the best we could provide in the circumstances. If you missed any of the talks, next week we'll be putting them onto YouTube, our YouTube channel. So if you go to our website, mmf.ac.uk, there'll be links there to the talks on YouTube, so you can watch them again and pick up on anything that you might have missed. So let me now conclude and thank you for attending, and look forward to seeing you at the policy conference. Thank you.